Abbott Laboratories, stock ticker ABT, is a multinational medical devices and healthcare company. Founded in 1888, Abbott Laboratories is now a $158 billion by market cap healthcare giant that employs 115,000 people. The company reports results across four segments: diagnostics, 38% of fiscal year 2022 revenue; medical devices, 34%; nutrition, 17%; and established pharmaceuticals, 11%. Nearly 60% of the company's sales are international, while the remaining 40% or so come from the US. As we can see, this is a broadly diversified healthcare company. That's true both in product and geography terms, and that's a great spot to be in as we enter 2024 soon. I say that because of the demographic tailwinds that are blowing this company's way. Healthcare is in secular growth mode. The world is becoming larger, older, and richer simultaneously. It does not take a big mental leap to understand how that directly leads to more demand for high-quality healthcare products and services. After all, we're talking about a larger pool of human beings who are living longer, and these same human beings are increasingly able to afford the kind of healthcare that is often necessary throughout the aging process to lengthen life and/or make life more comfortable. This is actually quite circular. It's partly because of higher quality healthcare and more access to it that many people are living longer than ever before. If you zoom back to 1900, we didn't even have antibiotics yet. Modern healthcare is a miracle in many ways. As one of the world's largest and most dynamic healthcare conglomerates, Abbott Laboratories is at the tip of that spear. That's why the company is positioned so well to continue growing its revenue, profit, and dividend for years to come. Already, Abbott Laboratories has increased its dividend for 10 consecutive years. While a good start on its face, this is somewhat short track record belies the company's true dividend growth commitment, which actually stretches back many decades. Indeed, Abbott Laboratories is actually a dividend aristocrat. A company has to have at least 25 consecutive years of dividend increases in order to become a dividend aristocrat. This disconnect can be explained by the spin-off of pharmaceutical assets by Abbott Laboratories into a new independent company called AbbVie Inc., stock ticker ABBV, back in 2013. This move reset the dividend and its growth, even though shareholders of Abbott Laboratories who kept their AbbVie shares were made whole and saw their dividend income continue to rise straight through that process. Putting that aside, Abbott Laboratories has declared 399 consecutive quarterly dividends since 1924 and has increased its dividend for 51 consecutive years. The dividend pedigree here is unquestionably great. A 5-year dividend growth rate of 12.1% shows plenty of gas in the tank despite decades of dividend growth already. And you get to pair that dividend growth with the stock's market-beating 2.2% yield. This yield, by the way, is 60 basis points higher than its own 5-year average, and the dividend is protected by a payout ratio of 46.4% based on midpoint guidance for fiscal year 2023 adjusted earnings per share. Abbott Laboratories has one of the most storied dividend growth histories out there. This is the stuff of legend. Other than investors who only go after high-yield stuff, I really can't think of anybody who would dislike anything here. Looking at business growth, Abbott Laboratories raised its revenue from $19.7 billion in fiscal year 2013 to $43.7 billion in fiscal year 2022. That's a compound annual growth rate of 9.3%. Strong. I like to see a mid-single-digit top-line growth rate from a mature business like this. Abbott Laboratories is knocking it out of the park. Meanwhile, earnings per share grew from $1.62 to $3.91 over this period, which is a compound annual growth rate of 10.3%. Boy, double-digit bottom-line growth from a dividend aristocrat. One can do a lot worse than that. Looking forward, CFRA currently has no 3-year earnings per share compound annual growth rate forecast for Abbott Laboratories. That is unfortunate, as I do like to line up the proven past with a future forecast, even though the future is obviously so difficult to predict with any kind of reliable accuracy. That said, CFRA does have an interesting and insightful nugget in their analysis. CFRA sees, and I quote, record earnings per share of $5.58 by 2026 as Abbott Laboratories' standout glucose monitoring technology, Freestyle Libre, gains market share, unquote. So there you go. If we compare that to the $3.91 that Abbott Laboratories printed for fiscal year 2022, that would be a compound annual growth rate of 9.3% over this upcoming 5-year period. Basically, CFRA seems to be assuming a continuation of the status quo, more or less. I don't see anything wrong with that, as Abbott Laboratories has been a model of consistency for decades. It just steadily marches its revenue, profit, and dividend higher in a very unceremonious way. I'd also like to point out this glowing passage from CFRA on Abbott Laboratories. Again, and I quote, "We think shares of Abbott Laboratories will outperform the market and peers over the long term, driven by its highly innovative, diversified healthcare business, allowing for growing market share over time, a strong financial position, and a consistently growing dividend," unquote. Isn't that beautiful? It succinctly highlights what's so great about a long-term investment in Abbott Laboratories, which is supported by outperformance and a dividend that consistently grows through thick and thin. If we take CFRA's near-term model as our base case for what Abbott Laboratories can do in terms of EPS growth, that would allow for similar dividend growth. With the payout ratio being as low as it is, there's even some flexibility for the dividend growth to slightly outpace earnings per share growth. That is to say, the dividend is set up for low double-digit growth over the coming years, which would be right in line with what's been occurring over the last several years already. Again, it's incredible consistency, and you get a market-beating yield while you wait for those dividend raises to stack up. I find that to be very compelling. Moving over to the balance sheet, Abbott Laboratories has a fantastic financial position. The long-term debt-to-equity ratio is 0.4, while the interest coverage ratio is over 11. These numbers don't really do the balance sheet justice, though, as cash on hand nearly covers all long-term debt. Moreover, long-term debt has decreased meaningfully over the last several years, all while the company's cash position has simultaneously increased. There has been a marked improvement in the balance sheet here. This is against a backdrop of many other companies out there gorging on cheap debt, showcasing great stewardship from the management team over at Abbott Laboratories. Profitability is very good. Net margin has averaged 12.8% over the last 5 years, while return on equity has averaged 14.8%. There is a lot to like about this Dividend Aristocrat, and with economies of scale, IP, R&D, entrenched sales relationships, technological know-how, and regulatory expertise and barriers to entry, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. I see all three of those risks as elevated for this particular business model relative to a lot of other business models. On the other hand, high regulatory hurdles, especially around medical devices, act as barriers to entry and stave off new competition. Being an international business, Abbott Laboratories has exposure to different jurisdictions and currency exchange rates. Product recalls are a constant risk. There's execution and product quality risk, as evidenced by the company's recent issues with baby formula production. The introduction of new weight loss drugs in the marketplace may reduce demand for some of the company's various offerings. The company faces some technological obsolescence risk, especially around medical devices. I think these risks are worth considering, but the quality and growth of the business must also be considered. And with the stock down more than 30% from its all-time high, the valuation, which looks attractive, also has to be considered. The stock is trading hands for a price-to-earnings ratio of 22.3. That's based on trailing 12 months adjusted EPS. For a company that's reliably grown its bottom line at double-digit rates, that strikes me as a very reasonable earnings multiple. I'd also point to the price-to-sales ratio of 4.2 being well off of its own 5-year average of 4.9. And the yield, as noted earlier, is significantly higher than its own recent historical average. I thought you'd choose using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. That dividend growth rate is at the very upper end of what I allow for, but Abbott Laboratories is exactly the kind of business model that gets the benefit of the doubt. This is a dividend aristocrat that's proven a rare ability to grow the dividend at a high rate for decades on end. Anything can change and nothing is ever guaranteed in business, but Abbott Laboratories has been one of the most reliable dividend growers that's ever existed. With the payout ratio being low and the near-term picture for earnings growth being supportive of low double-digit dividend growth, I think my model is, if anything, just slightly cautious. The dividend discount model analysis gives me a fair value of $110.16. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates ABT as a 4-star stock with a fair value estimate of $104. CFRA rates ABT as a 4-star buy with a 12-month target price of $113. I came out pretty much right in the middle. Averaging the three numbers out gives us a final valuation of $109.05, which would indicate the stock is possibly 12% undervalued. Here's the bottom line, guys. Abbott Laboratories is a terrific business benefiting from long-term structural demographic tailwinds that put its entire industry in secular growth mode. With a market-beating yield, a low payout ratio, double-digit dividend growth, 10 consecutive years of dividend increases, and the potential that shares are 12% undervalued, long-term dividend growth investors looking for a good deal on a great business have a strong candidate here. And now for a special news announcement. ASML NV, stock ticker ASML, recently released a good Q3 report with sales up 15.5% year over year. Guidance for the year was reiterated, and management sees significant growth in 2025 after a flat 2024. This is one of the best businesses on the planet, and as our recent video explored, it looks attractively valued here. Don't forget about ASML. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.